My name is that guy up front who sings a lot. If you don't know him, my name is Kelly Clemens. We've been here at the church since about 2016, 2017. I can't remember exactly. Before that, I was a pastor in ministry. So what gives me the right or the authority to stand up here and talk about financial matters? Well, that'll be included in the presentation. But after I left my church and we came here, I joined a financial firm that I had been working with for 10 years. And so I work with a company called Eagle Financial Solutions. That's an independent financial company. Our main office is in Columbus, but the way the world works today, so much is just virtual. So that's what I'm doing. I'm a licensed life insurance agent. My company handles all the areas of financial services. So, stocks and all that kind of stuff. But my specialty is in the area of life insurance. That's where my licensing is. I purposely chose not to get what's called a securities license. That's where you would deal with stocks and bonds, right? There's enough opportunity in this area. But again, we have that available. And so I have, those type of accounts as well. So just so you know a little bit about who I am. So let me read a scripture here. First of all, as we begin, remember our focus for the weekend is leaving a legacy. What we're going to talk about today is, couldn't be more fitting with that thought. But so in 1 Corinthians chapter 15, now I make known to you, brothers and sisters, and this is beginning of verse 1, the gospel which I preach to you. I make known to you the gospel which I preach to you, which you also received, in which you also stand, and by which you are also saved, if you hold firmly to the word which I preached to you, unless you believed in vain. For I handed down to you as of first importance what I also received, that Christ died for our sins according to the Scriptures, that he was buried, and that he was raised on the third day according to the Scriptures. That's the gospel, right? That's the gospel. Now, when it comes to financial matters, all right, there's no gospel, all right? Just want to share with you today. These are my thoughts, right, from the things I've learned. These are some of the principles that Valerie and I apply in our lives. I hope it will be helpful to you. If you listen to what I have to say and say, that's not for, I've got no interest, right? Or none of those things apply, well, sorry, it's an hour of your life you won't get back, right? But I think there'll be things here that, anybody should be able to get something out of, right? And maybe there's something you want to take a little bit further. Before I forget, if you want to, you can write down my cell phone number. So my name is Kelly. It's 419-788-0307. I got a few business cards. I'll make sure to bring some more tomorrow and leave them out if you want that. So based on that, this morning's talking about saving, all right? We're not going to talk, again, we get into the financial world, we could talk about all sorts of things, right? Investing and 401ks and all kinds of stuff. We'll touch on a few things, but I really want to focus in on saving, right? So when it comes to saving, especially saving money, right? Saving money ultimately is very simple, right? Just do it. But it's not necessarily easy, right? If it was easy, this room would be empty. Right? You wouldn't be in here. Saving takes commitment. Saving takes a long-term vision. Saving employs delayed gratification. And we have to build a mental practice, right, for ourselves, an internal satisfaction where we enjoy saving as much as we enjoy spending. Maybe even get to the point where we enjoy saving even more than we enjoy spending. Let me just read a definition of the word save. Some things are going to be familiar in here. One of the first definitions there is to keep safe or to rescue from harm or danger, right? A doctor might prevent someone from dying. In Christian use, it's to preserve someone from damnation, right? They're trying to get me saved, right? People say, come up, is that seat saved? And what do we say? No, but we're working on it. So it's saved. That idea there. And then the typical definition as far as we think of in financing, right? To keep and store up something for future use, to preserve by not expending or using it, right? We hear the term for young people, we say, save yourself for marriage, right? That's saving, right? And I want us to think about some of those things outside of the financial world here today. When we think about saving and leaving a legacy, we need to be people that save things, right? That hold on to things that are important, right? If you, right, are married, you have a family, what do you need to do as you go about your day, right? If you're out away from home and you're about your day, you need to save some energy for when you get home, right? That when you get home, you haven't totally depleted yourself and you have nothing left to offer your family when you get home. So it's a principle that goes all the way across our Christian life, right? It's not just about our finances. So how did I go from being a pastor to working in financial services? Well, just very quickly, my mom was a single mom. My dad died when I was 4 years old. She raised 3 kids, paid for our college, never felt like I was, in need the time I was growing up, but she was a school teacher. She never made more than $35,000 a year. Raised a family, bought a home, bought another home, lived in a nice home in Findlay, Ohio, and in about I can't remember, when she was around 70 years old, started to show signs of dementia. So I had to take over her finances and started getting her statements and realized this lady who was born in 1930, right at the beginning of the Depression, always said, I'm broke, I'm poor, and I got her statements. I said, man, I wish I was broke as you were. And realized that she had saved, right, a significant amount of money. And with her house, there was about $400,000 that she had saved over the years. And so through some advice that our family got, we took some of that money, $250,000, we put it in a trust, and we gave it to someone, and they put it in typical, mutual funds. And we had a couple family meetings, and that money, $250,000 in a very short time, over just like 2 or 3 years, maybe not even that much, had grown to $350,000. We had a family meeting. I said, you know what, we've had a great run. Maybe we should do something, and my family said, great, what should we do? I said, well, I don't know, right? At the time, I just had typical average, knowledge of, I knew how to balance a checkbook, right? A few of those things. So we had a conversation, and, things just sort of got pushed to the side. Well, unfortunately, that conversation was November or December of 2007. Now, some of you might remember what happened in 2008, right? The financial world went from here to here. And $350,000 went to under $200,000 in a moment, right? And I was crushed, right? I was like, my mom worked so hard, and I lost her principal. $250,000, now $190,000, right? Now, what do the financial experts say? Just be patient, it'll come back, right? Right? Well, during that period, it took a long time for us to come back. They call it the lost decade, right? 2008 to almost 2018, things were really, really slow in coming back. Problem with that situation is, it's fine, let it ride, except my mom died in December of 2008. And now, among my 3 siblings, instead of splitting at least $250,000, maybe $350,000 if we'd been smart, we dispersed $190,000. That sent me on a personal journey. It's like, I need to get informed. I need to learn more about these things, right? The first thing was that person who was dealing with us didn't even ever ask the right question of us, right? What was the most important thing about that money? That it was there for my mother's care. Not how much we grew it, that we didn't lose it. That if mom needed that for her care, she spent 5 or 6 years in assisted living, right? The last 3 or 4 years in a memory care unit. Right? So we need to ask that. That frustrated me, and it set me on a journey, and that's how it brings me to where I am here today. So to talk about these things. So quickly, it's a picture here, just sort of an illustration. What does that look like? Anybody, any ideas? Just, what is it? Who said it? Plumbing, right? Kind of looks like plumbing. Well, why is that? Why is that important? Why does it work? Well, because our finances are kind of like water, right? They kind of work like water. We work a job. We have some sort of source of income, whatever it might be. It comes in here, especially if you're in your working years. This tank is your lifetime capital potential. We could go into that extensively and talk about that, but that comes in, right? And whatever you have is going to go back out. And if you are a spender, you're going to dump some of this off through taxes. Can't get away from that. And then it's going to flow out for your lifestyle and out and down the drain. And once it's gone, right? Nothing you can do about it, right? So that's why this kind of looks like that. And then we have a couple other tanks bolted onto our plumbing system here that are places where we could store money, right? Storing money. That's ultimately what we're talking about when we talk about saving, is storing money. And so we can do that either in an investment tank, and that's your 401k, your 403b. These things don't mean anything to you. Don't worry about it, okay? But the government approved funds that you can use. A lot of you have them through your employer, those things. And then you have your safe tank, right? That's the Dave Ramsey tank, right? Where he tells you, right, get those baby steps and save yourself that $1,000, right? And that's where we want to focus our thoughts today, right? Is that safe tank. Where are ways, what types of accounts should we be using for saving money, okay? Not investing money, right? That's a different term. But for saving money, for money that I have available to me, right, within a day, right, day or two, right, and I don't have to what we call liquidate or pull from assets, right, that are earning higher amounts of money. Well, we'll talk about some of those accounts here this morning, how to fill up that tank and the possible benefits of them. So what about cash, right? Hey, I'm just going to keep a wad of cash underneath my pillow or underneath the mattress, right? Or in a safety deposit at the bank, right? So I might do that. Well, what are the benefits of that, right? Well, obviously, if I've just got cash and I need to use it for something, I'm not going to pay any taxes on it. I've already paid the taxes on it, right? If I have cash. I can stick as much cash underneath my mattress as I want to, right? Or I can have it sitting in my checking account. So, if I have some money someplace, I could possibly borrow against that lump sum of money, right? We'll talk about going through that. Obviously, cash is something that's very safe. My cash, unless I lose it, right? I hid it someplace in the house and, oh no, I put $2,000 away. Where did I do with it, right? Somebody's going to find that someday when they buy my house and move something around. It's very... With money, what we call liquid, right? Like water. It's like, it's easy to move around. I have the use of it. I have control of it, right? That's one of the things that are there. So normally in cash accounts, and we'll look at some of these other things, if you go to your bank, and in the past few years, remember, how much money did the bank give you to hold your money, right? 0.1%, right? Almost nothing. Now, it's getting a little better now, but that also means what? On the other side, that things cost more now. So a number of different provisions in here that you can look at, some of the, the possible negative sides. But cash is one way, right, to hold on to money. So that's filling up that tank over there. Okay, over here, we look at that and we fill up that safe tank, right? So we can just have cash sitting. Certificates of deposits, right? You might know them as CDs. Okay, you go to a bank. You give the bank an X amount of money, and for 12 months, 2 years, 3 years, 4 years, 5 years, they will pay you a guaranteed interest rate on that money for that period of time. My mom was a great CD saver. That's how she did it. Right? Now, remember back in the 60s and 70s and 80s, some of you might remember, some of you are a little bit younger, you could get 8, 10, 12% on a CD. Right? Now, remember, inflation is 8, 10, 12%, so you're barely keeping up with inflation, but that's better than it's just sitting right under a mattress. You're losing ground with your money. And so most of that money she did through CDs. And in the 80s, she got in the market a little bit and just came in at the right time and grew her account there with that. So certificates of deposits, something from the bank, right? You can make high contributions, right? If you want a jumbo CD, right? $50,000 or $100,000, they'll give you 20.25% more on your interest. But what's the problem with the certificate of deposit? If you need that money, what happens? Right? They say they're going to penalize your interest. You can get your money back, but you're going to lose your interest. All right? So it's but there are some situations. Again, it's very safe. You can borrow against that account. We did that. My mom did that for me when I got out of college. I needed a car, so we went to the bank and said, look, I'm going to put up the CD and borrow the CD for collateral, not the car for collateral. And so we did that. So potential for you there. Something you may not be as familiar with, something that's called fixed annuities. All right, that's not a 4-letter word, annuities. Okay, despite what popular radio host may have to say. All right, an annuity is basically just a CD offered by an insurance company. Okay, typically they have higher rates than a typical CD. Okay, they're very safe, high contributions you can make. The nice thing about an annuity, different from a CD, and a CD at the end of the year, you're going to get a tax form for the interest you earned on that CD, and you're going to have to pay taxes on that money, right? In a CD, every year you have that in there, you're going to have to pay taxes. In a fixed annuity with an insurance company, you're not going to get taxed until you pull that money out to use it. So you get to defer your taxes, so you have more money in there to compound on that interest. See the advantage? And with a fixed annuity, also typically, at the end of every year, you can take some of that money out without any penalty. So you see how that adds liquidity, right? You can get access to your money. But again, it's something you need to be committed to for the long term. You're going to have penalties if you take out more than you should. Money market, just sort of a turbocharged checking account that pays interest. Okay, very safe. You, again, put in as much as you want. Can borrow against it. Typically no loss provisions. Remember back in the financial crisis, if you remember these things, a typical money market was called, the value was $1, right? And the money markets actually fell below $1, sort of like the first time since they'd been brought in. Right? And they quickly came back. But so they're very, very safe, but still interest rates tend to be low. But that's okay. It's okay for our savings bucket. Give you another one here. A savings account, right? Many of you probably have that, right? Savings account at the bank pays you a little bit more interest than your regular checking account, right? So we put our money in there and we get all of those benefits over here again. We can put in as much as we want pretty much in a savings account. We have access to that, right? But we're still getting some growth on it. What is not on this list that you can think? Some things we might have already mentioned. Okay, your typical retirement accounts, right? Your 401k, IRAs. Roth IRA is something you may have heard of. It's not on our safe account. Those are things that are over here in the risk tank, right? They are not appropriate tools for our safe account, right? me read you something that Warren Buffett. Everybody know who Warren Buffett is? If you don't, he is one of the most famous Americans in the world of investing. Used to be one of the richest men. Now that all these tech giants have come in, he's kind of fallen down the list. But he's been a great financial wizard. I think he's from Omaha, Nebraska. I think they call him the Oracle of Omaha. But he has this statement here. He says, access to capital is more important than rate of return, right? Some people are always worried about, I got to get a bigger return on my money. Well, the more return you want, the more risk you're going to have to take, right? But having access to capital is so important, is so vital. So making sure that we have that when we do that. So the typical world of financial planning and people's idea of planning for their future is this idea, right? The money comes in. I have a 401k through my employer. Before I get taxed, I dump that money down in here into this tank, and I start filling up this tank, right? Maybe I come over here and I push a little bit up over here and I put a little bit in the savings tank, but for the most part, I put it over here. Or, typical as we've been told by some people, I save up, I get a house, and then I start dumping money into my house, right? Someone has told us, take that 15-year mortgage, pay extra, and pay off this house, and store your money in your house, right? So you pay that mortgage down, so the house is mine. Well, ask the local government when you don't pay your real estate taxes if that house is yours, right? Ask the people in New Orleans after Katrina if that house with all that equity is theirs. Ask the people in Maui if that house with all that money in it is theirs. Ask the people in California. Ask the people in the town here in Ohio, right, that had the rail. Can they sell their house right now? Can any of them go to the bank right now and say, hey, I got all this, right? My house is paid off. I got $1 million house. Give me a loan on my house. I go, what house? I see ashes. Is that a safe place to store your money? I don't know. You have to think about that, right? So some of these safe places.
So Kelly,
yes, ma'am.
HSAs.
Same thing, access, right? Using an HSA for its purpose, it can fit in here, right? That's kind of in the border, but it's locked in, right? It's for this use, right? Now later on, again, it can be a similar thing. And I'm going to try to get through some of the stuff and leave some time for some questions because I know you will have that. So sort of back to my story. Remember we talked about I went on a journey. Well, did I ever tell you where that journey ended? I guess it ended here, but why did it end here, right? Let's go back to these things. One thing we didn't talk about, right? Talked about cash, certificates of deposit, fixed annuities, money market, savings account. One thing we didn't talk about was something called cash value life insurance, okay? This is not a sales pitch here this morning, folks. I just want to open your eyes to some opportunities out there, some things that you haven't heard before, all right? You hear ads on the radio. Fisher Investments will say, I hate annuities, right? Why does Fisher Investments hate annuities? Because they don't sell annuities, right? They want you to give them the money where they want to do it, so they get paid, right? Again, our friend Dave Ramsey will tell you anything other than term insurance, that greedy life insurance salesman called Kelly Clemens just wants to steal money from you. He wants to get a giant commission so he can buy a big house and a big boat and drive a really nice car. Well, guess what? When I went on that journey, high cash value life insurance was the answer I found for our family, right? These other things are part of it, but that's a huge part of what we started to do. So the question's going to be, Kelly, what in the world is high cash value life insurance and how does it work, right? What is that all about? Why does that fit in the saving tank, right? How does that fit in a saving tank? So let's just take a few minutes and let's talk about this idea of just life insurance in general, right? How many people in here have a life insurance policy? Okay. How many of you in here have a term life insurance policy? Right? Do you even know? Right? You may not even know whether it's a term life insurance policy. That's good. That's something to go home and check and find out what you have, right? So when it comes to life insurance, right, we typically think of, I want to go to a life insurance company, I want to get a death benefit, right, that covers me, that secures my family's future, or at least helps them if I were to pass away prematurely, right? We know one thing, we all have an expiration date stamped on the bottom of our foot. The bad part is it's stamped on there in invisible ink, right? But the guarantee is, and we saw that this week, right? 31 years old, right? Charlie Kirk, gone. Right? We all know in our families someone who has passed away prematurely. My dad, gone at 4 years old, right? What is going to happen, right? So something we are doing for our families, right? And life insurance is not a needs financial product, believe it or not. Life insurance is a wants financial product. What do you want to happen to your family if you go early? Do you want them to be rice and beans and rice, or do you want them to be filet mignon and, right? Do you want them to have to shop at Aldi or drive around here to get the things here? Do you want them to shop at Kroger or Fresh Time or Whole Foods, right? Do you want them to drive the cheapest beat up wreck of a car that they can afford just to get, or do you want them to have a nice safe vehicle, right? What do you want to happen? How do you complete your plan if you're not there, right, to complete that plan? So again, let's say you want to get a typical death benefit of $500,000, right? Well, there's a minimum amount of money that you could pay for a $500,000 death benefit. There's also a maximum amount you could pay for that same amount of death benefit, right? You could pay a low number, you could pay a high number. Who determines, anybody know, the minimum amount you might pay for $500,000 of death benefit? Any thoughts? The insurance company, right? They have people that they pay to figure out, you know, how many people are going to die this year, what age are they going to be, and they know that risk factor. And so they say, look, for $500,000 of coverage for someone 30 years old, you know, with good health, they can pay this much a month. And we can still make money. Yes, ma'am?
So I always thought you were kind of supposed to figure out your health, your life insurance policy based on like your family size. Okay, so I'm a single, it's not going to take as much to bury me, or nobody has to carry on without my income, that kind of thing. But it seems like what you're proposing is that you should more target an end amount versus your family.
We'll get there. Yep. I think you start to see what's happening here. So yeah, again, if you're a single person, this just death benefit, you know, maybe what I get through work, you know, to help my family, you know, one time's my salary, the group insurance that's free. Hey, that's going to help my family, you know, clean out my apartment, or, you know, take care of the things with my estate. As you're got more responsibility for other people, you might start to think about other things as far as that goes. So the insurance company determines that based on how little can we charge and still keep the doors open on the business, right? If they're a stock insurance company, pay our stockholders. If they're a policyholder-owned insurance company, which are called mutual insurance companies, all right? They're owned by the policyholders, right? The profits from the company, after they pay their expenses, go back to the policyholders, right? So when the insurance company does well, the policyholders get money back, right? Where does the cash value in your life insurance come from, right? It's called a dividend that they pay back. It's just determined in the insurance world for the interest you would get in a bank account. Give me a second here. But believe it or not, the same amount of death benefit, you could pay more than a minimum. You could pay a lot more than a minimum. You could pay a maximum amount. And who determines that? Well, the government determines that. If the government wants to get involved in something, what are they after? Money, tax money, right? They're after tax money. So if they want to get involved in setting, right, what you can pay, how much you can put into life insurance, it's because they're concerned about taxes. And between the minimum and the maximum with these life insurance policies, there's an infinite range of product design. It can be tailored specifically to your specific needs. So in the 1980s, the government, again, they saw that wealthy people especially, but not even that, ordinary people were sticking a lot of money into cash value life insurance, right? They were using that to fill up their safe tank. Okay, over here, they weren't using CDs or just holding cash or some of those other things we talked about. They were using life insurance to fill up this safe tank. Well, the government said, no, we want you to put money over here before it's been taxed so we can tax it later, right? So they started to create different types of accounts so they could get after that, called qualified plans, right? What do they qualify for? They qualify for the government to come get the taxes later, right? At a rate they decide would be best for them. What is a qualified plan, right? It's financial plans that we use that we can defer the taxes on, right? We get our paycheck, and before they take out the taxes on our 401k, they put money into your 401k that brings down, right, the balance, and then we get taxed from that point, right? So they defer the taxes. But what else do they defer? Not just the taxes, but the tax calculation, right? What's another word for defer? How about postpone, right? They don't promote these accounts as postponed tax accounts. Defer is a word that kind of slips by us. Postpone just means you can pay me now or you can pay me later, right? Well, in this situation, maybe paying now is right? Not the best idea, or is the best idea, but we're told, no, just pay it later. But a couple questions you need to ask. If you're going to postpone the tax calculation is what? What tax bracket will I be in when I retire? If you're young and you're starting out, you're not making much money, right? When those tax brackets come, you're typically getting a refund, right? Wow, look at that, right? As you get older and you start to earn more and your income goes up and your lifestyle goes up, right? What might your tax bracket, by the time you retire and you've accumulated, you've filled up those tanks, right? Your house is paid off, your children are gone, right? The other thing you might not have is you might not have the same deductions you had when you were young. So you've got to think about those types of things. What about taxes, right? Let's look at tax thresholds. Look when 1913, when the federal income tax began, right? The threshold for the lowest bracket at 1% was $20,000. Threshold for the highest bracket, and it was 7%, and you had to make over $500,000 in 1913, right? Look how quickly that changed. Look here. The lowest tax bracket, $20,000, and then in 1917, it went down to, oh, you're going to start getting taxed when you make $2,000. What happened in 1917? World War I, right? We need money. So they could change the rules, right? Stayed at 500,000. So things changed all over here, right? They're always changing. We just went through a big fight, right, on the extending the tax brackets that were put into in the first Trump administration, right? And we had this battle. And I'll tell you what, we are in the best tax rate time of any of our lives, however long that lasts, right? So there's going to have to be some major changes in the government for those to change. So it's a great time to take advantage, whether you're starting out or you're already have accumulated on that. So, excuse me, sorry. Look at this chart just on where tax rates have been. 1950s, in the 1950s, look at that. The top bracket was paying 91%. Are you going to go to work and earn if you get to keep 10 cents on a dollar? Right? 70%, 50%, 40%. We're right down here where the top tax bracket for a married couple is around 35%, right? That doesn't mean you pay 35% on all of your money, right? We have a graduated, right, income tax. It starts at 10%, works its way up as you move into different brackets, but great opportunity to take advantage of that there. So let's get back to our story here. All right. So the government came in and said, you can put money into life insurance, but now we're going to set a limit. And if you go over this line up here at the top, your life insurance is going to become what's called a modified endowment contract. Okay, big word for just means we're going to treat it like these accounts over here, like these qualified accounts, with all the rules and all the penalties that were there. So you can finance up to this line, but if you go over, it's going to cost you if you do that. So again, there's a minimum amount that you could pay for that death benefit, right? There's also a maximum amount you could pay for that death benefit, okay? The minimum amount that you could pay for a certain amount of death benefit is called term insurance, right? Call up the life insurance company, you say, I need some life insurance, sit there and talk through, maybe you know how much you want, right? I've got a young man, he's in his 20s, he's not earning much, right? He's got a small family, but it's like he wants to protect his family. He got a $1 million life insurance policy for a term of 20 years, right? For like $25 a month. Pretty good bargain, right? For that. For 20 years, he's got his family covered, right? He'll get $1 million, right? If he dies next year, how much money does his family get? $1 million, right? If he dies at year 19 of that policy, how much money does he get? $1 million. If he dies at 20 years and 6 months, how much money does his family get? Nothing, right? Because his term has expired. He spent that money and now, right? It's just like your car insurance or your house insurance, right? You pay it if a disaster doesn't happen, well, right? But we know it's necessary. It's there to protect us in case it does, right? That's the thing about term insurance. Now let me ask you a question. $1 million 20 years from now, is it going to purchase the same amount of things as $1 million today? No, right? That's one of the risks of term insurance, right? Every year, the value of it is less, right? What's the best day to own this type of insurance?
Day one.
Day one. I'm going to pay every month $25. I just paid for $1 million. I leave my life insurance agent after signing the paperwork, giving him the check. I go down the street and I get hit by a bus. Hey, that's a great return on your investment. Probably not one you want to sign up for, right? But it's a great return on your investment. And that's what it's there for, right? We hope we don't ever recoup our money, right? Or we get to, 20 years down the road, we've accumulated things, we still have a family, and go, okay, now I need to get another policy. Well, I'm 20 years older. Is it still going to be $25? No. Oh, I've been to the doctor and he's concerned about this spot on my ear or on my face, or this test has come back. Am I even going to be able to get insurance? Right? Is it going to cost me more? So things to think about when it comes to term. There's a place for term. All of these things there's a place for. So you get one benefit with term insurance. It's a death benefit, right? If you don't die, the money's gone, right? But that's what it's there for. So let's just stop again and let's go back and review. In our safe tank, what type of, right, benefits do we want, right? We want tax-deferred growth, all right? Our growth, we want to postpone the taxes because, right, that money is more money that can compound and grow for us. We want tax-free distribution. Wouldn't that be great to get to retirement, be able to pull out money, and we don't have to pay taxes on, right? How much more, right? We could save less and do the same amount. Right? If we know we have to pay taxes, we've got to pay more. I've got a friend who is a 401k millionaire, like a lot of people are. That means he's got over $1 million that's never been taxed. All right? How much of that money does he have access to? He's got access to all of it now. He's over 59 and a half. Hey, wow, I got over $1 million. Well, guess what? If I want to go get that money, I got to think about taxes. If I want to go buy a house for $500,000, I got to pay 37% on a lot of that money. I got to pay in the 30s. I got to pay 20. It's like, it's going to cost me 25% of that money, right, to go do something with. So he had postponed the taxes. He wants to get it out. He'd like to use it, but he really has to think about those things. Would something in our safe tank get a competitive rate of return? Can we make high contributions? Are there additional benefits to it, like maybe long-term care included with it? Protection against lawsuits on it? Could I borrow against that? Is it safe? Is my money safe? What about, again, no loss preventions? I can't lose my principal. If I want to borrow from that, it's guaranteed I can get my money if I want to do that. If I want to pay it back, unlike if I go borrow money from a bank, right? They say, okay, your first payment is due next month and it's this much, right? Well, what if I could borrow money and say, guess what? I'm going to choose when I start paying that loan back. I'm going to choose how much I pay on that loan. So that'd be a great opportunity for it. Do I have liquidity, use, and control? And it'd be great if I could get deductible contributions, but I think we've seen from this that maybe that's not the most important thing we're looking for. So again, coming back to just our thing here. Death benefits, sometimes when we get to the higher end, we're not as concerned about the death benefit as we are what? Getting those living benefits. All of those other things over there are called living benefits, right? Now again, just quickly back to our story. Val and I had just gotten married 2008, and now we're bringing additional income into things, and so we just said we want to get life insurance for each other. And I was at this place where I was frustrated, and I actually heard an ad on the radio about this idea of called bank on yourself, right? There's a lot of different terms for this: infinite banking, the family bank, this type of philosophy. But ultimately it's about using high cash value life insurance from a mutual life insurance company, right? The policy owners own the company, right? As part of your retirement plan, right? So we looked at this and we just said, look, between us, here's how much extra income we have. We just got a policy on each other, and we started putting money into that. Now, Val worked for the post office. We still contributed the amount they matched, right? No more than the amount they matched was our decision, right? We weren't going to fill up that, but take the free money, do that. But this is where all of our money was into that policy. I didn't exactly know, I didn't have this totally figured out at the time, but I was just like, man, this just makes sense. When I read about it, studied it, and when we got married, Val had a couple of duplexes that she had bought, and so she had her own home, and I had a house and then a duplex that I had owned. And so we both had this, this thought of, hey, we'd like to get into this and build this. So over the next few years, we were putting money into that, and then we were putting in money into purchasing real estate. And as our cash value went up, we would go into our safe tank. That was our life insurance policy. We would pull money out of that, right? And we would invest it in our real estate. Now again, if I pull money out of that from my life insurance policy, I might have to pay interest to the company I own, so it's my benefit. But I'm making really high money over here in my real estate, so I don't really care about that, right? I'm making so much more, and then I could pay it back on my terms. So just quickly back to this, and then we'll try to get to some questions here before as we wrap up. And this, again, just an opportunity, something to think about. And this is something you can do at any age. It can be something you can use for retirement, especially that legacy idea. But then you can plan for a legacy, but it can be there for you as well. But notice the difference here. With term insurance, you get one benefit. You get the death benefit. But with what's called whole life insurance, which maybe you've heard is bad, but again, any product out there can be good. It just depends on how it's used. You get all these benefits over here. And as you start to fill up your tank, right, you start to get even more. But did you notice this up here, this increasing face, right? Remember with term, for the term of that policy, you only get that $500,000. But as you pay more and more into your whole life policy with a high cash value, not only does your cash grow, but your death benefit grows too. So you're keeping up with inflation. You're building more for your family. Val and I started our policies in about 2007, 2008. They had built up a significant amount of cash in them. We'd used that cash to build our real estate. And just a couple years ago, I'm going to be 65 here pretty soon. We both just bought more cash value life insurance. We used the money that we had earned to buy even more, right? We don't have kids. Why would I do that? Right? The policies we had and the properties we had and the other assets if I go, Val's going to be fine, right? If Val goes, I'm not going to be fine. Doesn't matter how much money I have. We did that because we looked at it and said, we want to leave a legacy. A mom whose husband committed suicide when she was 35 years old. A gal whose parents were the children of Polish immigrants are going to be able to leave millions of dollars to organizations that we support and we love. Bella Vita here in town, Hillsdale College, Prager University, Bob Jones University. Don't tell Pastor Paul, Emmanuel Baptist Church. Because it's important to us. Because of what, right? We want to be able to take care of ourselves. We want to take care of our families. But we want to make sure that we have an impact on this world. We want to be able to give right now, right? That we can do. So typical financial insurance, right, is going to tell, or advice is going to tell you, fill up this tank over here, postpone the taxes, have a little bit of emergency fund over here, pay off the house, get all that equity in the house, right? But remember this red line. First of all, you put your money in investments. You don't have any idea how much you're going to have when you retire, right? No idea. This could be full. It could be, anywhere in here. It's going to go up, down. You don't know. Sorry about that. You don't know how much of that you're going to owe to the government, right? You could have the same thing over here. You could have a tax situation over here if you don't invest this money right. Here's my quick suggestions, and sorry, we're out of time. I knew this was going to happen. Rapid fire. Before you put money in this investment tank, even if you're getting a match, right? If you're young starting out, put money in this safe tank. My suggestion would be use cash value life insurance, but use some of those other things I showed you, right? Put money over here. How much should we put over here? $1,000 is great to start. Guess what? I would say push, push, push. And you may start putting into the investment tank, but keep filling up this tank. I would say, guess what? 6 months to a year of your living expenses. Think of all of these disasters that have happened. When are those people in California going to get their homes rebuilt? Right? 6 months to a year of over here. Not worried about return. I want to have access to my money if I need it. Right? So you need to look at that. Right? And then, right, it'd be great if you reach the end of life and this was like this and this was like this. I don't care about this. My philosophy over here is this is what my life is going to look like. I'm going to have a big giant mortgage on my house that the bank has to worry about when I go, right? I'm going to have these tanks filled up. Let me ask you one question about your home. When is your home paid off?
Never, because you pay taxes for your property.
Well, and is your home an investment, right? That's perfect. Is your home an investment? You don't have any idea what the value of your home is going to be when you go sell it. All the taxes and all the insurance you've paid, you're never going to get that money back, right? All the repairs and the updates that you've made on your home, right? You're never going to get that money back, right? So you have to think about that, right? Your kids probably don't want your house. A few of them might, but, you know, and then they got to deal with the hassle of selling it, and they got to clean out your stuff, which is going to break their heart. They're going through, oh, look at this picture. I got to throw it in the dumpster, you know? And guess what? That's the story of our lives. My mom had a beautiful home that she lived in for a long time, and she moved out of that into a one-bedroom apartment. She moved out of that into, right, a small little one-bed room. And she moved out of that into a shared one-bedroom with a closet. And the day my mom died, and the day after, I went in her room, I took a picture off the wall that she had, I put some clothes in a box, and I walked out, and that was my mom's life. As far as stuff is concerned, right? Her legacy is the money that she had earned and saved that Valerie and I took and we put into real estate, and we built a nice real estate portfolio. And we've been able to put more money into this safe tank and into these investment tanks, and we're able to use that to bless people and to be able to leave a legacy, right? There are great lessons in here. I'd love to talk to you about just interest and paying cash for things and paying off your home. So just quickly, a couple minutes, let me give you some practical ideas, all right? I want to save. Look, if you're living paycheck to paycheck, everybody in this room has probably been there, right? That will end. Right? If you are wise, right? You have to find a way to live below, right? What you earn, right? To live. And then as you earn, you can start to save. And then as you start to make more money, your lifestyle is going to increase. But you have to have that mindset of, I am going to be a saver. So where do I find money, right? Where do I find the money? You just have to trust me on some of this, but I'll try to talk through. I have a couple of slides here I could show you, but when it comes to your mortgage, conventional advice in Christian circles, Dave Ramsey, right, all things are, get that 15-year mortgage, but pay it off as fast as you can, right? Pay extra on your mortgage. My advice to you is no, don't do that, all right? I can show you the interest you make on your money going up versus what you're paying to the bank, and every month you're paying them less and less, right? Even if you have a higher interest rate you're paying the bank than what you're earning, your money growing will come out better than that. Don't pay extra on your mortgage. Put that into your savings tank. Because again, we've talked about the money's in your house. You got a bunch of equity in your house, you lose your job. Is the bank going to give you a loan on that equity? Right? No. They call a banker, right? Someone who will loan you an umbrella when it's sunny. But when it's raining, it's tough to get, right? So don't pay extra on your mortgage. Don't pay extra on your car loan. It's a depreciating asset, right? If you have a car loan, don't pay extra on it, okay? Your cell phone service. Are you paying for a bunch of bells and whistles that you don't need? Get in and evaluate, right? Can you do that? Your deductible on your insurance plans. if I got a big, huge, right, safe tank over here, can I afford a $1,000 deductible on my life insurance or on my car insurance or home insurance, right? Versus a $250 or $100 or a $50 deductible. When are you going to get in an accident, right? How much can you save over the years? And that money can be compounding. That money can go into something else, all right? So there's just a few things. I would love to talk to you about, again, we get here that borrowing is bad. Borrowing is bad if you're trying to elevate your lifestyle with income you don't have, all right? Borrowing can be great if you're strategic and you use the bank's money the right way. And so my money over here in my safe tank can keep growing, right? Versus I save a little and then I buy a car and I drain my tank. I save and then I drain my tank. I save and then I drain my tank, right? Or I save and I save and I save and I have this money over here and I use the bank's money for some other things, right? As long as in my cash flow I can do that. My money keeps growing over here while I'm paying, right? I'm paying off the bank. Let's just say over here it's coming down, 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 right? And my money is able to keep growing. So quickly, we'll like 5 minutes for any questions. I think it's 10:30 and stuff. I haven't looked to see, but we got a little bit of time if you need to run out for something. So let me just pull up that safe screen for you if you want to see those items. I'm not saying don't put money in your 401k. Some people that have discovered some of these things don't put money into those investments accounts anymore. Because with those investment accounts, you have fees. You have the opportunity of losing your principal. Example of my life, right? My mom's life. But using all things in balance and filling up both those tanks. But I would say get as much into that savings tank before you start going after higher returns, right? So questions, thoughts? Again, anything I say here today is not personal advice, right? Instruction is just common knowledge. Go ahead.
It sounds like you were saying then that your high cash value life insurance gives you liquidity. And I didn't know that. I mean, I kind of figured it's a life insurance policy. I borrowed against a universal policy before and I had to pay it back. Of course.
Right,
So
yep. That's it. That's your liquidity, right? So you can collateralize it.
You're borrowing it.
Yep. So, and there's different terms you might, if you go out and search for this, please come talk to me before you go to somebody else. The things that Dave Ramsey talks about, there are whole life policies that are called variable life, which means it's attached to the stock market. So it's not in your safe tank, right? It's like a term policy with an investment policy attached to it. That's not the type of policy you use for this, all right? It's whole life cash value policies that have a guaranteed dividend. These companies, many of them are over 100 years old. They have paid their dividends or their interest every year for 100 years. Through the Depression, through World War II, right? Through the crazy times of the 60s, through the 2008 financial crisis. They're some of the most stable, right, financial institutions that we have. They've been around a long time. Your grandparents used to use cash value life insurance until Wall Street came along and snookered us into putting our money in the market so they could get rich. This is the way people used to save. The insurance company would come around on Friday afternoons with the paycheck and collect their $50 or their $25 and put it into these accounts. And when they retired, they had this cash amount built up. Quickly, let me just share a story. When I started a pastoral position in 1990 or something in Philadelphia, a guy at my church talked to me about this. I put $200 something into a policy. I looked at that. At one point, it would be like worth $250,000. Like that was like unbelievable amount of money to me. I was like, I could get that someday. Well, I left that position and I stopped paying on that account. I eventually got back into it and looked at it, had some cash value. I used it for something and that policy was gone. And again, I was a stupid kid. I didn't know anything. I was just thinking about this as I was thinking about this presentation. I thought, that $200 or $250 at that time, and especially after I left my position and I was in between work for a while, would have been really hard. But eventually that $250 today is like sneezing. It's like nothing. And I sit here and I think, now, 30 years later, if I had continued to pay on that, in addition to what we have, what a chunk of money I would have had if I would have just been, as we talked about, disciplined, committed to the long term, right? Using that as a tool. And all the things that cash value you could have done with, right? Used for, right? The rate, if I borrow for my policy right now, the rate on that is like 5%. If I want to go get a car loan, a new car loan right now through a dealership, I'm going to pay like 7%. Could I borrow from myself and save interest and then pay and then guess what? I pay it back and I pay myself 7% instead of the bank 7%. It's a lot of opportunities here in this. So something, if you're interested, happy to sit down and talk. There's no obligation to talk to me. But again, don't get caught in the conventional wisdom, right? Which says little bit of savings, big investment, big tax postponed, put your money in your house, right? I, had a house that we bought in 2017, and if interest rates start coming down again, it's hard to beat some of those interest rates we have on our homes right now, right? 3%. But you know what? You can create cash flow by refinancing your home to 30 years, and the lower payment you have, that's what's going to go in your safe tank. We're always going to have a place to live, right? What if you can get the payment for that lower and put more money in your safe tank? So quickly, 2 or 3 minutes. Any 1 or 2 questions? Anybody? If you don't,
I have a question.
Yes, ma'am.
So if I already have a 15-year loan already on our house and our percent's like 2 something, should we not do refinance and go to a 30?
it's all going to be personal, right?
Okay.
But my question would be, how are you doing? Again, the money I'm putting into my house, it's all money that's going back to the bank.
Right.
I have this equity. What am I going to do with that?
Right.
If I haven't filled up these other things, if I don't have enough to cover 2 or 3 or 4 or 5 or 6 months, right? And again, I say keep building that up. It's something to definitely look at. I'm happy to talk to anybody, happy to look at your situation, right? And I won't say, yes, do this, right? An unlicensed professional can tell people what to do on the radio, right? In a 30-second phone call. We don't do that, right, in the actual profession. We sit down and talk with you and see what your needs are, what works best for you. But start to think about that. It's not pay everything off as fast. Like, why did people not pay off mortgages in the past? Or why did they want to pay them off fast? Anybody know? Why? Why did that become a thing? Pay off your mortgage, pay off your mortgage. Because the bank could come and say, your money or your home. Right? So the government came in and changed the rules and said, no, if you have a 30-year mortgage, you make your payments, they can't come and say, right, I want your money. Right? It's a wonderful life. Remember, your money is over here and here, but the bank comes and says, you and you, I want your money. Right? All right. Anything? Feel free to call me, text me. Kelly, I'd like to talk. Happy to do that, give you advice. Let me pray for us as we finish. Lord, again, thanks for this time. Thanks for these people and their commitment to hear and to listen. Lord, we understand that ultimately leaving a legacy and to save, preserving the truth of the gospel and the message of the gospel is what we are here and what we are committed to. And to live as faithful servants of you in managing all of the good blessings that you have given us. So guide us through the rest of this day as we go. Bless our time together, that even in the midst of pain over many of the current events, that we know that you are present here us now, that we are in the kingdom of God now, that you rule and reign in our hearts today. It's not something we are waiting for. You are here with us. You are present in us. And there is nothing that we lack in our lives as far as our protection from the consequences of our sin. There is therefore now no condemnation to those who are in Christ Jesus. We possess that now. We are your people, the temple of the living God. You dwell with us right now. Help us to live in that and to rejoice in that. We pray in Jesus' name. Amen.